This is what I would call the tech portfolio. I try to diversify in a lot of different things. I try to cover many different areas, specifically just AI, Mag 7. That's it.
Just the Mag 7.
And so Steve, often feel like you
So
did.
I will confess that of the Mag 7, I own every single one of them.
Except
for Tesla.
Ah, interesting. Okay.
Oh, man, dude.
So what I would like to ask here.
By the way, I just want you to think about Tesla.
Yeah, please.
Just from a perspective of people who do real fundamental work and how difficult it can be to short stocks. So peak earnings of Tesla were in 2022. The company earned, I think, $4.50. And this year, I think they're going to earn $1.50. So the earnings are down from 2022 through 2025, 60%.
The market cap.
And the stock is slightly higher. So I was just thinking, imagine, you're an analyst at a big hedge fund.
Yeah.
And you go to your PM and you go to the PM, you go, I got this great thesis. There's this company, it's called Tesla. I know you've heard of it. My thesis is that from 2022, the earnings are going to go straight down every year until we get to 2025, where the earnings will be 60% lower than 2022. And I think in 2026, they'll be lower still. What do you think? Let's short the piss out of it. And you're 100% right fundamentally. And the stock, and it's a cult, so it doesn't work.
Yeah.
You go crazy.
Yeah.
So why doesn't it work? We did a whole episode where we sort of analyzed and debated Tesla, and
because it's a cult.
The cult can't justify $1 trillion valuation.
It's a
right?
cult. I think what people really sincerely believe, and this was Dan Ives on my show, The Real Eisman Playbook.
Real Eisman Playbook.
His thesis is that Tesla is going to do very well with robotaxis and AI and
robots
and robots.
In your house.
And
it's
Steve is saying this, by the way.
And it's all going to be great. And that's why you got to own Tesla.
Yeah.
And don't continue from there. We're going to clip that.
And you know what? Number one, you could be right. And number two, there's no argument against it. Like you're arguing against something that'll happen in the future, and people believe in it.
No. The argument is what you just said. The earnings are down 60%. That's the argument.
And it didn't work.
But as an individual, you don't have to be part of that crowd. You could be like, I don't want to keep owning this declining car sales company.
Okay, this is crazy. This actually loops into a question I had about the crisis and the movie perfectly. There's a part of the movie where, and you bring this up, the frustration of dealing with a bank like Goldman, who refuses to adjust the price of the swaps in a way that reflects the market because they set the price, right?
Correct.
And this feels similar in that all the underlying data that you're looking at
is bad.
Indicates that Tesla shares should be going down.
But Tesla doesn't set the price.
But in that case, Tesla doesn't set the price, right? At least the market is setting the price in this position. But coming back to the movie for a second and the actual crisis that happened, you were talking about how you still don't know to this day why Goldman or these other banks weren't lowering the prices. And I was wondering if you
I know why they weren't lowering the prices. They weren't lowering the prices because they own the stuff on their own balance sheet.
Yeah.
And they didn't want to mark it down.
Okay, that's what they say in the movie as well. I was wondering what part is confusing or not confirmed still then that you were explaining.
What happened, the confusing part to me was not that some firms didn't mark down their books. That I understood. What I didn't understand was there were two different types of securitizations back then. One was called cash in and one was called cash out. And don't ask me what those things are because I used to know and I don't remember. Okay, but one was better than the other.
Okay.
Yeah,
and we were short both.
Okay.
And so what happened was I get a call, and generally Goldman's prices were honest. Merrill Lynch didn't lower prices. We didn't deal with them. I got a call from my Goldman salesman, who was a lovely guy, and he said, "We got to have a conference call with you." I said, okay. So we set up a conference call, and it's me and all my guys are in the room, and it's him, and then it's like his boss, and then his boss is like, this is serious.
Okay,
serious.
That's a big deal.
And I don't remember whether it was the cash in or the cash out, whichever one was worse. So let's say like on the last day that we got prices for this stuff, the average price was like 70. And we had shorted the stuff at par. So we were already 30 points in profit. So he comes on the phone and he says, we checked our models and we realized that the methodology we've been using to price your bonds has been wrong. And so we have to reprice all your bonds of this type. And so, okay, I go, so the last price was 70. What's the price? He goes, 80.
At a time when you expect the price to be going down.
Every day.
Yes.
Okay, this is like late spring.
Sure.
So then I said, okay, well, so the price is 80. I said, so give me a two-way. Meaning, the price is 80. But if the price is 80, I'll short more at
buy
80
more,
all day
short
long.
more.
Yeah.
All day long. Gimme. But of course, there's a bid and an ask. So it was 80, 60 was the bid.
So they'd only let you short
So
it at
I could
60.
short. So something that he says just reprice me from 70 to 80. If I want to short more, I'd have to short it at 60.
But they're only marketing at 80.
Right.
Is
That's
that
why to this
illegal?
day I don't understand what
How,
happened.
yeah.
Like, is it illegal? Is what they're doing?
Why is it illegal? They set the price. There's no screen.
Well, then why would they ever even have to?
I don't understand what happened. To this day, I don't know. It's a mystery to me what happened. I don't know what
It's
happened.
so funny because I brought this up hoping to get a clarification. Like, because in the video you say like I don't really know what happened.
I don't
It's
know
like,
what happened to this day.
Yeah.
That's wild. It feels so incentivized to lie at all times.
Yeah.
To you.
But
All right,
still,
okay.
it's better than 2008. It sounds like right now. Wait, so real quick, one more on tech. So we hit Tesla, which is I think valuable, and actually in the Real Eisman playbook, which I was watching, you spoke with both a VC friend and then the one this morning.
Yes.
Basically, how most of the stock growth right now in at least the S&P 500 is coming from these tech stocks and from AI, where you're saying
100%.
right, and the money being spent is at least coming from cash flow. They're not in debt to do this,
Right.
But it's all hinging on AI generating enormous value. And I
Correct.
think what is a very plausible scenario. I don't think this is real. Obviously, tech. We all agree. Tech's the
No,
like for
don't let me in. Don't let me in.
years we have been just like you, trying to convince everybody that AI is perfect, and
Don't let me
and we're
in.
going insane. I'm just kind of curious how likely, even let's say it's the tech bubble in 2000, but on a smaller scale, that at some point the next couple AI models come out, that iterative leap isn't as exciting as people realize. They're starting to realize, wait, this really doesn't work for customer service yet, and the entire S&P loses all of those gains,
Look,
thus triggering.
if there's an announcement, if you listen to Nvidia, it's definitely not this year and it's not next year. But let's say in 2027, Meta comes out and says we're cutting our capex budget in half. Lights out. The market's going down 20%. Just poof, gone.
Do you feel as long as the capex, as long as they continue to put the money there?
Now, Saudi Arabia is now spending money, and UAE. There's now like the second derivative. People were spending all this money building data centers all over planet Earth. I mean, it could be, in a sense, a redo of the bubble in that Henry Blodgett, by the way, I used to work at Oppenheimer, which was when I was on the sales side. And in 1998, Henry Blodgett was at Oppenheimer. He was in the office across the hall from me. And he would get on the sales floor every single day. And he said, the internet's going to conquer the world and dynastic levels of wealth are going to be created. And he was 100% correct.
Right.
But at first, the returns weren't there. And that's why we had a tech recession. So you could have a situation where the timeline that people are hoping to have real returns on this stuff doesn't really materialize and people pull back. And then eventually it does happen.
Is on the other end of a...
That could happen.
I mean, Zuckerberg was on a podcast a few days ago saying he would rather lose a few $100 billion to be early and then be too late. But he expects it to be like 3 years. If it's not,
that the returns will be there in 3 years.
yeah, well, he's saying,
Right, but if it's 8,
if it's 8,
7,
yeah, then the $100 billion.
I mean, right now,
Yeah.
for example, when you go on Google and you do a search, you get 2 responses. You get your old search response and you get the AI response. I mean, the AI response is better. It's not the Albert Einstein. So we need more proof that there's going to be real returns that are coming. But it's early, so you can say whatever you want.
But it's hard to sit out, as an investor.
I'm not sitting out.
I'm just talking to our audience. Like, if a lot of them are invested in the same thing as Doug here, where this stuff has been working.
Right.
When it dips, they buy it because it's going to work. It's been
Going to
working.
keep working.
And so you don't have a word of caution for them in that? You think it's
Not yet.
Okay, not yet. You think
Because even even somebody like myself who puts a lot into the S&P thinking, well, let me diversify. I don't want to go all in on tech. In reality, I am investing into the tech growth. Really.
Remember, the problem is like, what would you diversify into? Procter & Gamble? I mean,
Well, that brings you to my next
Well, that is a great question. That leads to the other millennial.
a third portfolio.